Good morning. Thank you for joining us for today's webinar, where we'll talk about the CECLSolver and how we can assist with the transition to the new accounting standard. My name is Sean O'Brien, the president of QuickRate. And as always, I'm pleased to be joined today by Steve Huntington. Steve's the director of analytics here at Quick Analytics and is instrumental in the development and evolution of our CECLSolver. So Steve, if you want to go ahead and introduce yourself.
Sure, thanks, Sean. Thanks everyone for joining us this morning. So by background, I've spent my entire career working with community financial institutions in everything from strategic planning and valuation work to capital planning, model development and maintenance. And I've spent about the past decade or so working with Sean and QuickRate here to take all those types of tools and analysis from that sort of a background and put it into an environment where we can make it a lot more easy and efficient to use by our QuickRate customers.
Sure. Thank you, Steve. So just again, a couple of reminders before we get started. We're in presentation mode, which means hopefully you can hear us, but we can't hear you. So please submit any questions throughout the presentation. We'll be monitoring those and either take them during the webinar or at the end, but one way or another, we will address those. Secondly, as always, we will send out a link to today's recording as well as a copy of the slide deck. Certainly, thank you all for being QuickRate subscribers. If you're not, welcome as well. We certainly, are known for our non-brokered CD marketplace, 35 plus years providing non-brokered funding to community banks. More recently developed analytical solutions called Quick Analytics, where the CECLSolver is contained, as well as IntelliCredit, where we provide third-party loan reviews as well as affordable cloud-based solutions to help better manage your loan portfolio. I think in all these solutions, we're trying to aggregate data on your behalf so you can spend your time analyzing the data. We think that's a much better use of everyone's time. And so we've spent a lot of time trying to, again, build technologies that can be, that are both affordable but easily deployed in your institutions. Quick Analytics, as I mentioned, just, by way, CECL is one part of it. So when you do subscribe as a CECLSolver solution or a subscriber, you get access to a whole lot more. So we just want to share that and remind that with you. Quick Analytics is really designed and kind of spread out between three different areas. One, bank and peer performance reporting. Two, interactive bank pages where you can do a tremendous amount of research about yourself or other banks. And then regulatory and compliance tools, and that's where you'll find our CECLSolver. So a whole lot here, more than CECL, but we're going to focus on CECL today. And, we've been doing these presentations for a couple of years now. And as we get to the home stretch, with CECL in our window here, if you will, I think it's important to not lose sight of what we're trying to accomplish, right? Reserves are designed to cover expected losses. Capital is there to address unexpected losses. Regardless of the kind of the tools and rules of engagement, that's ultimately what we're trying to do. And I think it's important, given all the talk about CECL and the fact that we've been, discussing this topic for nearly a decade, I think it's important, and we're going to touch on just kind of resetting our expectations as we get closer here to the finish line. I think probably there's a few, overriding sentiments or questions we continually get from banks about CECL. First off is, why are we even bothering changing it? Right? I think we have to remember a decade plus ago when we were in the midst of the financial crisis, everyone recognized that the ALLL did not work the way that it wanted to. FASB recognized it, the banks recognized it, the regulators and auditors recognized it, as well as readers of financial statements who came to not really trust what were being presented in financial statements. As a result, if you are the FASB and you know something doesn't work, you really have two options. One, you don't fix it, right? Which opens you up to, if it happens again, people will say, well, why didn't you fix it? You knew it didn't work. Secondly, your other option is you change it. CECL's the change, right? So again, it's important to recognize while we're changing the rules of engagement, we are still trying to set up, reserve levels. And in some ways, and I say this very tongue-in-cheek, we're playing the same game with a new set of rules, right? That's what we're doing. So we're going to just explain to you how you can, meet the new standard. But at the end of the day, this really is the same kind of game that we've been playing with the ALLL, but now we have new rules of engagement. There are a number of similarities to the ALLL, and is one of the reasons why we like the WARM methodology that Steve is going to show you here in a second. Q factors are still a big part of the process, but now we are going to incorporate, a much longer look at losses. That's the lifetime life approach that CECL really wants banks to do. And then secondly, we're going to incorporate, if necessary, the ability to pull in forward-looking reserve, through our Q factors if that's something that's not being reflected in our historical losses. We've come a long way since the standard was officially recognized and introduced in December of 16. Obviously, COVID and the pandemic pushed back the implementation date, but we have been talking about this for a very long time. But along the way, a lot of theoretical considerations have been, replaced by practical realities, and we will discuss a few of those here. As I mentioned, I think it's very important to reset your expectations. In some ways, it's probably good to, forget a lot of what you heard about CECL and just focus on now getting to the finish line. I think the regulators have certainly done this. Jeff Gear, who's the OCC associate chief accountant, has spoken consistently about this, that small banks don't need big models. I heard him most recently say this at the FMS conference on the regulator panel in June, but he has been, outspoken in his belief that small banks don't need big models. We believe and concur with his sentiment. There's certainly been, lessons from the 2020 adopters that parallel runs are crucial. They're helpful. They get you comfortable, and they also kind of let you see where you are. In addition, CECL is scalable. I think this is important to remember. Your burden is, expected to be commensurate with the size and complexity of your institution. In other words, small banks don't need big models, right? Let's not try to be to overthink this. There's our very practical and straightforward ways to get to the finish line. We have consistently said to be practical, to be realistic. I think we've seen that, from a regulator's point of view, they are going to be very tolerant of multiple methodologies. They recognize we're trying to estimate a reserve, in an accurate reserve, and not necessarily a doomsday scenario reserve. But I think most importantly, from everybody's point of view, the reality is that the more constrained by data that you have at the bank, the more straightforward CECL gets. In other words, you can only do what's possible. For a lot of banks who don't have 10 plus years of loan level information available to them, the only real way you have to address CECL is through a portfolio solution that utilizes call report information kind of as its energy source. Again, this is a very concrete example of theoretical considerations being replaced by practical realities. In addition, for those banks utilizing your historical losses, many of you may be sitting here today saying, well, I haven't had any losses. Exactly. That's why, again, the other thing that's become accepted as a supplemental piece of information, and you'll see this in our tool, is incorporating peer data as a supplemental resource and of loss history. So again, most of you don't have losses in your portfolios, so you're going to look to peer data and Q factors to defend the reserve. Same game, new set of rules. There have been a number of myths out there around CECL. I think it's important to recognize there's not one right solution. There are many ways you can get to the finish line. Subjectivity is still playing a role in this because of the Q factor process. And at the end of the day, the most important fact is a consistent and well-reasoned process can be constructed and followed and be more than acceptable to auditors, regulators, and you at the bank. There is no mandatory method, as I mentioned. You just need to be prepared, to document and defend why you selected the methodology you did. And, one final time, community banks under $1 billion don't need to engage in highly complex or expensive modeling. For all those reasons, that's why we introduced CECLSolver now over more than 4 years ago. We really felt like it could be a practical and understandable approach for banks to use. We've tried to aggregate the data and organize it in a way that makes your analysis and your time on this, very understandable. And then, as always with Quick Rate and Quick Analytics, we're here to help as much as you need us. We have a number of resources on our pages in our solution, so you can understand if you want to dig more into the guidance, but also more importantly, you can see the presentations that have been made by regulators to show effectively how community banks can address this utilizing portfolio solutions and incorporating the WARM methodology. So at this point, I'm going to turn the presentation over to Steve. He's going to walk you through our CECLSolver in a live demo. Steve, the screen is yours.
Thank you, Sean. Bear with me just a moment while I get this pulled up. Let me know when that's
I can
visible.
see your screen.
Excellent. Again, thank you, Sean. So what you're seeing in front of you right now is a live demo of our CECLSolver tool. It looks exactly as it would, except obviously the data is for a different institution. The sample, or the guinea pig, so to speak, for today is a larger community bank in the Northeast. And except for a couple of assumptions that I've tweaked for illustrative purposes, this looks exactly the way the tool would look the first time that our users log in. First thing that you'll notice is the initial segmentation that we have for the CECL tool is designed around the buckets or the pools that we can get from the call report data. The call report is an excellent energy source, as Sean mentioned, for this type of a tool, because it gives us consistent long-term data on balances, charge-offs, recoveries, and past dues by segment, going back in time as far as we need to, or even further than we need to, from a CECL perspective. And it gives us that data not just on your institution, which is certainly a time-saving aspect of a tool, not having to spend a huge amount of time inputting all of your historical data, because we have it ready to go the second that you first utilize the tool, but also your peers' data, right? As Sean mentioned, there's a lot of situations. I'm sure most of you on the call probably have at least one, if not many, segments of your portfolio that have experienced negligible or completely zero losses over any reasonable look-back period. Yet we find ourselves having to justify a significant reserve on those segments anyway. And so the ability to go outside your four walls and look at the environment around you to say, well, we might not have had any losses on our C&I portfolio over the last 5 years, but let's look not just at ours, let's look at all the C&I loans in our part of the state at similar sized community banks, and look at what losses there are, again, outside our bank in the community around us, and use that as part of our justification or narrative around the qualitative factor adjustments that we're making to justify the reserves that we know are going to be required no matter what, no matter how clean our portfolio has been in recent years, right? The other thing that you'll notice about our tool is that the entire tool lives in an interactive environment in the cloud. And what that means to you is every time you change any input or assumption anywhere throughout the tool, the entire math process recalculates on the fly. So if you make an adjustment to your WARM, or you make an adjustment to any of your Q factors or anything else, you can instantaneously see exactly what impact that's going to have on the CECL reserve requirement, not only for that segment, but for the entire portfolio. This makes the process of coming up with scenarios, or maybe multiple scenarios as of any given point in time, a lot more quick and efficient. You don't have to plug in hundreds of inputs, wait for an output to come out, print it off, look at it, and then try to compare it to another, set of inputs that you had. And you spend a huge amount of time sort of reverse engineering, what moved the needle here? Why is it look so much different this quarter than last quarter, or after we change one little input? With our tool, that's not really ever an issue, because you get to see instantaneously exactly what impact all of your changes will or won't make as you build your scenarios. But let's kind of take a step back here and just walk through how the tool works. Because, as Sean mentioned, we're heavily utilizing the weighted average remaining maturity, or the WARM method, which is certainly one of the more straightforward methodologies that's been vetted by the powers that be and approved for CECL compliance for the vast majority of community banks out there. The first step is really getting a handle on what those average remaining lives or average remaining maturities are throughout our portfolio. Now, that's one piece of the puzzle here that we can't get, at least directly from the call reports. So we need a little assistance from our users in order to calculate those WARMs. Obviously, the easiest way to accomplish that is to simply, call your core processor and ask them for a report that has your WARMs calculated by call report bucket. Every once in a while, you strike gold and that actually works, and they have those reports and you can run them, and it's not a big issue. But we don't, that's not necessarily the case most of the time. And so we find a lot of our users are calculating their own WARMs internally. We have a spreadsheet tool that shows you exactly how you would go about calculating the WARM if you were doing it yourselves internally. And if that presents its own set of challenges from a timing or a resource standpoint, we can take care of, all the way through to calculating your WARMs for you, where we can set up a secure environment where you can upload your flat file or your loan level data, and then we can update and calculate your WARMs for you on a regular basis. So rest assured, as much or as little assistance as you need in calculating those WARMs kind of at the front end of your CECL methodology, we can help out with. But once we have a WARM calculated, we plug it in here into the tool, and then the tool is really off and running. And then recalculating and kind of handling the vast majority of the number crunching for us. So let's take an example for today. Let's say that we'd calculated our owner-occupied CRE, the WARM to be 4.25 years. As soon as we plug in 4.25 years here, it takes about a second, and everything just recalculated pretty much on the fly across the board as it pertains to owner-occupied, non-farm, non-residential. Now, what I mean by all that stuff recalculates is, if we know that the remaining life of this segment is 4.25 years on average, we know that what CECL is really requiring of us is that we project 4.25 years worth of future losses right now, right? Losses over the remaining life of the asset is what CECL is all about. So if we're going to project 4.25 years into the future, our tool takes a symmetrical view of the look back period, at least by default, meaning we're going to look at an actual 4.25 year period in your history and analyze your experience. How did your how did your balances changed over that 4.25 years? How many losses have you accumulated? What direction are those losses trending in? How many recoveries have you had? And we'll take all that historical information and use it to calculate the first real big piece of the puzzle for CECL, and that is, what is our bank's historical lifetime or life of the loan loss rate? The answer for these guys for owner occupied is 18 basis points. Now, there is a ton of math numbers that go into that 18 basis points. Because the methodology we're utilizing is pretty straightforward, as is our take on it, all of the supporting data that goes into that calculation there is available right here in the historical analysis tab. So this is where we can dig a little bit deeper and see all that call report information that's going into that calculation. Everything you see here on the screen would be preloaded into the tool for your bank whenever you log in. And every time you file a new call report, it gets updated as well on a quarterly basis. Not just for you, but for your peer group as well. So if we're looking at the owner occupied again, there's 4.25 years. First thing we're going to do is analyze balances and take a look at them. You can see here for each segment, we've kind of highlighted the look back period in blue, so you can just visually get a sense for, which segments of my portfolio do I have much longer durations, and I'm going and taking a larger swath of history in order to get a feel for what my historical lifetime losses have looked like. But you can go back in time further than you need to if you want, just by scrolling left and right. But we can see over that 4.25-year period, their balances have gone from just about 290 million up to about 330 million in owner occupied, and they've averaged about just over 290 million dollars over the entire 4.25-year period. Now, if I scroll down here, I can expand and see the detail. Next, we're going to analyze gross charge-offs. So we can see over that 4.25-year period, this is how owner-occupied charge-offs have accumulated. They've totaled about 550,000. And if I expand the recoveries, I can take a look at the recovery trend as well as a separate trend. And I see how recoveries have accumulated also. And then finally down here at the bottom, where the rubber really meets the road, is net charge-offs. So here's our net charge-off trend over time, and I can toggle over to ratios so I can see, as we always typically like to do, what those annual and year-to-date net charge-off ratios look like, and then finally what that life of the loan or lifetime aggregate loss rate is of 18 basis points. And so if I head back over to the summary, that matches up to the 18 basis points we saw here from the historical detail. Heading back here to the historical detail for just one more second, I also wanted to point out that while we by default have all of our look back periods be current or come to the most recently available data, you can certainly roll back the clock if you need to, whether it's on one particular segment of the portfolio, let's say 1 to 4 family residential construction. If I wanted to look at 2015 and 2016 as my look back period, I can just say, hey, I want my look back period to end at the end of 2016. The blue bar shifted over to the left, and everything just recalculated to utilize your historical data from those 2 years specifically in calculating a CECL reserve on your 1 to 4 family resi construction. If this is something you wanted to do for the entire portfolio and literally roll the clock back to say, what if it was right before the pandemic started? Let's say today is March 31st, 2020, right before it hit the fan, apply changes, and I can literally roll the entire clock back and do some back testing and do some calculations as to what would it have looked like from a CECL basis if we were to have done these calculations as of March 31st of 2020. So it allows you to do some what if analysis and even some stress testing of your portfolio and how it held up in different historical points in time. If that's something that helps you in building some maybe more punitive scenarios in your CECL analysis. But for today, I'm going to roll the clock back. So as you see, as I'm rolling the clock back and forward, everything is recalculating, and it takes a couple seconds when you do a wholesale shift because it's a ton of data. But as you do that, everything translates here to the summary page. So at this point, we've kind of tackled the first half of CECL. We haven't looked outside your bank to peer data or to environmental or economic data, we haven't projected anything yet. But we have got a handle of, if we were to perform going forward exactly as we have in the past, this is how much reserve we would need. Now, the second half is all those adjustments, right? All those qualitative factor adjustments that cumulatively reflect all the reasons we think current and future conditions might be a little different than the historical conditions which we just calculated. So this is where we can take into account our peers' experience, especially in segments of the portfolio where we might have little, if any, loss history. This is where we can take into account economic adjustments. This is where we can utilize a lot of those qualitative factor adjustments that you've been currently using, right? The concept of the Q factor is not new shouldn't be new to anybody on this call. We have always been, looking at some of that interagency regulatory guidance where they have those 9 suggested qualitative factor adjustments that banks should at least consider when making their assumptions for projected losses going forward. Now, do you have to take all those into consideration? Certainly not. But in addition to these sort of hard-coded environmental adjustments. You can add additional custom, whether it's, changes in credit score or risk grade migration, whether it's changes in mix or underwriting standards from the interagency guidance. You can add additional qualitative factor adjustments to modify your historical experience and get you where you need to be for your expected future loss rate. As you make these adjustments, the net adjustment recalculates on the fly. And this interactive chart here as well does. These charts here on the right are great because they provide kind of a visual summary of all the most important elements of CECL all within one chart. So as I click through the portfolio here, I can see my bank's long-term trend in losses in that segment. So for 1 to 4 family revolving, the blue bars represent my bank's historical loss trend over time. The green line represents my peer group's loss trend. And I'll talk about what I mean by my peer group in just a second. Sean, don't let me forget to do that. But the green line represents the peer group trend. The gray shaded area represents the look back period that we're utilizing for that segment right now. And the orange line is the ultimate kind of CECL estimate as of all the inputs that we plugged in. If we change an assumption, let's say I were to jack the Q factors way up, and you can see, then all of a sudden this chart kind of updates on the fly interactively, and the CECL estimate gets a lot higher. And if I adjust it, and then it adjusts back down. So you can see that it gives you a good idea visually of where you're at. This is also where you can sort of overlay some economic trends on top of your experience and your peers to see if you see any decent correlation there and want to make any economic adjustments, whether it's unemployment rate or expectations for inflation or CPI, what have you. Another benefit of these sort of summary charts is it allows me also to go kind of upstream a little bit, because net charge-offs are the bottom line when it's already hit the hit your income statement and your balance sheet. But what happens, what about those loans when I'm trying to find emerging credit risk, right? Before it becomes a net charge-off, the first time it really hits the call reports in any public way is 30 to 89 days past due. So that's where you'd expect kind of a leading indicator of your credit trends. And so if you want, you can go upstream and say, hey, I want to look at my 30 to 89 days past due for this segment over the long run and compare it to my peers to get more forward-looking guidance on where we might be headed. And then the next step would be non-accrual. So it'll go from 30 to 89 days, it'll sort of migrate towards non-accrual. So you can see the spike here historically is typically obviously after a couple years after it's at 30 to 89 days, or at least a year. And then the peaks in net charge-offs are going to be, even further down the road from a chronological standpoint. So it allows you to kind of utilize all those trends inside and outside your individual bank to help give you an idea of where we might be headed. Heading back to the summer, actually headed to the peer data. So one of the ways we can really help out from a Q factor standpoint, you know what a lot of your Q factor adjustments are for all those internal adjustments you've been making forever. But we can really help and be value added in the Q factor area by providing very good segment level apples to apples peer data. We already talked about how that can be helpful. And the data comes from us doing this same analysis that we did on your bank when we looked back in history, looked at all these different look back periods and aggregated balance data, charge off and recovery trends. We're actually doing this entire process for every single bank in your peer group simultaneously in the background. So just crunching literally millions of call report data points in order to get this. What this peer data tab represents is loss rates by segment using all the same exact segments that we're using for your bank. So apples to apples from a bucket standpoint, and then looking at the same look back periods as we are for your bank. So what we can calculate is we can calculate an average lifetime loss rate by segment for the banks in your peer group that's a perfectly comparable value to your historical lifetime loss rate. And then you can use that, the discrepancy there to start making qualitative factor adjustments and say, while we've had 0 losses on C&I over the last 9 years, our peers have averaged about 15 basis points total losses there. And so while we still think we'll continue to outperform our peer group going forward, we're going to make a 10 basis point adjustment based upon the fact that we know those losses are out there in the marketplace around us, and we expect to perform maybe a little bit more in line with our peers going forward than we have in the past. So again, the peer data doesn't directly impact the CECL results until you decide that you want it to, right? You look at this apples to apples peer data and you decide if you want to make a qualitative factor adjustment based upon it. And then once you do, that's when it impacts your actual CECL reserve. And by your peers, let's talk about that for a minute. So by default, we just use a state-based peer group looking at all the community banks in your state. You can certainly say, hey, I want to do this with my UBPR peer group instead. And so you can always choose your UBPR peer group, or you can build any completely custom peer group that you want. Something that's sort of ubiquitous throughout our entire platform on Quick Analytics is the ability to very easily and intuitively build custom peer groups. So you can always come here to your custom peer groups page and say, hey, I'm a $350 million community bank in Northwest Georgia. We have 5 offices in 3 counties. So I really consider my market to be these kind of 5 counties in Northwest Georgia. So you can, in about 30 seconds, build a custom peer group that says, I want all the $100 to $500 million commercial banks in these 5 counties. So you can build it any way you want to. And as soon as you built that custom peer group, you can choose it from your drop-down box here. And then all the peer data will recalculate on the fly to represent that peer group. Heading back to the story here, once we finish the process of updating all of our qualitative factors and making notes on it, this is a huge best practice area here. We talk with auditors and the regulators on a daily basis, and they cannot stress enough how important it is for you guys to document. It's less important to them whether you make a 10 or 15 basis point adjustment. It's much more important to them that you have some sort of narrative built in around why you made the 10 or 15 basis points. So this is where you have your justification, your explanation of what your thought process was when you made these adjustments. And you do it at the segment level so that when you're done with this process and you come back in next quarter and you're trying to remember, why did I make a negative 10 basis point adjustment based upon risk rates? You have your explanation. This is what you were thinking last quarter when you made those adjustments. And when you export the tool and share it with your auditors or your examiners, they'll have an understanding of what your thought process was, because all these notes get exported with the tool and attached to the segments so that they can follow your descriptions and your narrative along with you. Makes the whole process a heck of a lot more efficient. So you can make notes in Q factors. You can make notes on the summary tab where you've made other adjustments and throughout the platform. But once we've made all of our Q factor adjustments, then we've really arrived at our expected future loss rate. This is simply our historical experience plus or minus the sum total of our adjustments is equal to what we expect moving forward. Once we have that, we need to apply that expected future lifetime loss rate to a current and appropriate balance of the pool, right, of the segment. Now, by default, we're only getting your current balances from the call reports on a quarterly basis. But this does not in any way limit how often you run the tool or when you run it as of. You'll notice all the current balance values are overridable. So you can come in here today and say, hey, I really need this analysis to be as of the end of July, not the end of June. So you simply come in here and override your quarter end balances with your month end balances from your GL. And then the analysis or the CECL calculation will be as of whatever date that you plug in your current balances. This is also where you would make any adjustments to your current balances to exclude any loans or portions of loans that are outside the scope of the CECL reserve calculation completely. Whether that is, let's say you still had $10 million of PPP loans on the books. You'd come down here to C&I, you'd subtract out or net out that 10 million, and you'd make a note here, just letting everyone know that we netted out 10 million in PPP loans. So everyone looking at it will understand why this might not match up to your current balance sheet or call report value. And it's not just the area of adjustments for PPP or COVID loans. If you have any loans on the books at fair market value that are held for sale, that's outside the scope of CECL. If you have any significant government guaranteed portions of SBA program loans, for example, those you'd want to net out. Pretty much any balance where if there were a loss for any reason, it wouldn't be coming out of your pocket, or at least it wouldn't be coming out of the reserve. We want to net those balances out and make a note of it. Once we've done that, the last thing that we need to think about is, are there any loans that we need to assess on an individual basis? Do we have any loans out there that where default might be imminent, where we have a good idea of what that loss might be defined? It no longer exhibits any similar risk characteristics of the pool. As much as we tried to keep it within the pool, we couldn't. That's where we manage the individually assessed loans in this tab here, where you'd come in, you'd plug in the loan information, what your expectation of collections is, and what loss there might be. Let us know what bucket we're pulling it out of, right? What call report category we're pulling it from, so that we make sure we don't double count losses on the same pool, on the same individual loans. So of our $1 billion in first liens, 350,000 was individually assessed. We split that small amount out. The leftovers, the 99% or whatnot, is the collectively assessed pool, and that's where we apply our expected future loss rate to get our collective pool CECL. We add those CECL reserves up. We get a total collective pool CECL balance or CECL calculation. This is where we then layer back in any reserve for the individually assessed loans. And then there's two other smaller pieces of the puzzle that we still need to take into account depending upon our situation. And that is, do we need to make any sort of adjustment for held to maturity securities? And do we need to make an adjustment based upon unfunded commitments? So we have a newer component of a tool, an adjustment for held to maturity securities. It's something that we've added to the tool a little bit later on in the game, just because its relevance is a lot lower for the majority of community banks out there. For example, this bank has a $5 billion loan portfolio, and they have $1.5 billion of securities. 99.9% of it is in available for sale securities on the books at fair market value, which is outside the scope of a CECL credit adjustment. So for this institution, their held to maturity securities are just $1 million. It's all in government guaranteed or sponsored entities, and so there's really no credit risk. So they don't really have any adjustment to make here, but it's a part of a tool if you need it to be. And then finally, making an adjustment for unfunded commitments. Now, having an allowance for off-balance sheet credit exposures is also not a completely new concept under CECL. There's already a line item on your call reports hidden in the other liabilities section that asks you to do a calculation there if necessary. In practice, we know the vast majority of community banks don't make any calculation or adjustment there. They just kind of leave it as zero. We don't know how well that's going to fly going forward. It's going to have a little bit of a renewed significance from a CECL perspective, and so we wanted to make sure you had a kind of a module here to walk you through the adjustment from an unfunded commitments standpoint. So we can help by pulling out or extracting your total unfunded commitments by segment from the call reports, and then we work with you to figure out how much of that is unconditionally or meets the definition of unconditionally cancelable that we don't have to worry about. Whatever's left over is your net unfunded commitment that we do have to manage from a CECL perspective. And then we have to jump through some mental hoops here because, in essence, what they're asking you to do is try to project future long-term losses on loans that really don't exist yet, right? So it's a little esoteric, but we take those steps of, estimating what the probability of funding is, and then what the duration of that commitment is. And then what type of losses you might see were those lines to be ultimately funded. Now we have some good default values here to help you along your way. Most community banks have not done some sort of long longitudinal study for probability of funding, and we understand that. So we give you some values here and some default assumptions that are based upon some regulatory guidance and from the FDIC. And as far as potential losses, were those lines to be funded? Obviously, we just finished a nice long study of what losses you have on actual loans here. And so we can use that data in the unfunded commitment section to help you come to a calculation. And we'll compare it to any current allowance that you might have, if you have any, and see what additional CECL reserve you might need, if any, for unused commitments. And really, that's the last step, right? Once we add those pieces in, we get a total CECL requirement. We compare it to your total reserve right now, and we see where you are from a CECL surplus or shortfall standpoint as of this point in time, as of whatever date we plugged in our current loan balances. And that's pretty much how the tool works from an A to Z standpoint. Now, once we have a scenario designed, we want to make sure that before we log off or go somewhere else, that we save it. As soon as you save your scenario right here, give it a name, give it a date, then it's uploaded to the cloud. It's saved securely on our system. You can come and access it anytime you want to. You can have as many people at the bank accessing this tool. We don't charge any additional fee for additional seat licenses. So if you need 2 or 10 logins, it's no difference to us. And you can save as many scenarios as you want to. The whole idea here is that this becomes a repository of all your saved CECL scenarios over time, right? As soon as you save it, everything is snapshotted as of that point in time. So they are historically accurate. So you can come in here and look, well, 9 months ago, what was the calculation and how have things changed over the last 9 months? So it's very easy to pull up scenarios quarter after quarter and just toggle between those scenarios to see exactly what's changing as we move through this economic environment and get closer to implementation date. And then certainly next year, once we're all living in a CECL world, we can track and trace and audit every single one of our values and see how it's migrating over time. When it comes time to sharing this externally, obviously, you're not necessarily going to want to give people access to the tool to play with all your knobs. And so you're going to want to be able to export the tool. We give you full control over how much or how little you want to export of the summary data, of the historical supporting data within the bank and the peer data, and all the visual aids for the summary charts and everything else, as well as the economic data. And you can either export all of it into a PDF environment, maybe just a summary if you're sending it to the board, or maybe the whole shoot and match if you're sending it to an auditor, or into an Excel environment. You can literally pull the entire tool, all the data and outputs into an Excel environment. So if you want to add columns or rows with additional notes and some additional calculations, you can do all that right in an Excel environment. And it retains all the spacing and shading and kind of formatting and readability of the interactive tool, so that if you wanted to share the results directly from Excel with the board or with an external party, it's sort of has enough visual appeal that you can do it. It's not just a raw, unformatted spit out, so to speak. So that's everything I wanted to point out about the way our tool works. We've also made sure that once the Fed came out with their scale tool about almost exactly a year ago now, I guess, we got a lot of questions or requests from our users to, hey, is there any way that you guys can help us if we wanted to also run the scale tool, without spending weeks pulling our hair out about the methodology and trying to figure it out internally and get the right peer data. If we just wanted a backup, right, a sanity check on our reserve or some sort of secondary methodology to satisfy our auditors or examiners, can you help us out? And so we went ahead and faithfully recreated the Fed's scale methodology. So this is not sort of our take on the scale tool. I would say our take is the CECLSolver, but this is an exact replication of the way the math works for the scale tool. We've certainly made it a little bit easier to work with. You can build your own peer groups here too, and utilize that data. The peer data is even more critical using the scale tool than any other methodology, because literally the scale tool starts by assuming you're going to perform going forward like your larger peers have performed. And then you have to make adjustments for how you might be different from your peer group. But the starting point literally is the peer data. So it's it's super critical assumption where you get that data from and how you aggregate it. So we kind of made that part of it a lot more efficient. But it works the way the scale tool does. And again, you can save scenarios and export the results, and then use that as a secondary methodology to back up your primary methodology here. And at this point, Sean, I think that's everything that I wanted to point out. Is there anything that I missed?
No, Steve. But we did have a question come through. Is
Sure.
there a user group or for questions, or do we get a designated person from QuickRate? So the answer there is both. Yes, we do have monthly. We call them coffee talks, where we have a format where we invite questions from our users. We'll usually touch on a couple of topics that we've been hearing about from our group, and we will take those in a Zoom interactive environment. Secondly, you do have the customer service team and our sales team, and Steve and my time. So our goal is to get you to the finish line. So we work with our team works with you to do it. Often the process for a lot of our new subscribers is to, once we've done a demo and they've come on, that first time or two through, we'll go through the numbers with you, make sure you have any questions, we get them addressed, and you get comfortable in the new process. So, again, our overall goal is to get you to the finish line. So we are going to take the necessary steps to make sure that that we have everything accounted for you. Steve, anything you want to add there?
Yeah. So a very common situation would be somebody comes on and they're inputting their data, or they're calculating their warms, and they got an unexpectedly high result. Like, I plugged in all my loan level data into your warm estimator tool in Excel. I've done my warm calculations. I'm getting 13 years for my CNI, and I know that can't be right. Is there anyone that can help me look through the data to figure out what's going on there? Absolutely, not a problem. Send us the data or give us a way to look at it, and we can help you through those issues so that you can get the right assumptions built into the tool. Another common scenario is, we ran the whole CECL tool. It's coming out a little different than we'd expected. Can somebody just kind of take a second glance at it and give us a sanity check to see if anything seems off? We're happy to do that as well. And so we'll give you whatever support you need to feel comfortable with what's coming out and be able to share it and defend it to your examiners on an ongoing basis. This isn't a tool, like we mentioned, this isn't a tool that we sort of acquired from some sort of development team that we're trying to maintain, and it's not very flexible. We built the tool completely from scratch in-house, and we have an entire team whose expertise is exactly in this type of analysis and building. So we are there to help, and we certainly can help in any way necessary.
Yeah, and I would just add, before I got on the webinar this morning, I was actually doing that very thing. We had 630 numbers from a bank in Nebraska. They had put them in, and we walked through the tool and talked through the tool because they have an OCC exam coming up, and we wanted to get them prepared to address any questions, and they wanted to be comfortable speaking to their regulator about the CECLSolver. So yeah, we're here as much as you need it. So just kind of touching on these are just some recap of really what Steve talked about. We put them in here more so you have them as a reference when we leave today. But Steve, anything you want to add here?
Yeah, no, just again, this is just a summary of how the tool works in a PowerPoint slide so that you can print it off and share it in your organization after the call today. Just a reminder that, with the methodology we're using, you're plugging in those warms. That's the only, if you want to call it heavy lifting, depending upon where you're getting them from. Then the tool is off and running, does a lot of the calculations. You spend your time just going through your qualitative factor adjustments and thinking about what assumptions to make and how to justify them, which is how you should be spending your time building your CECL tool, not crunching and reconciling the numbers, but thinking from a high level about narrative and justification and reasoning. Next slide. Just reminding you how the qualitative factor adjustment tab works and how the individually assessed loans tabs work, and how you can go upstream and get data on non-accruals and 30 to 89 days trends by segment, and just sort of get some more data to help you justify what direction you think losses are headed going forward. The individually assessed loans is where you can plug in anything that you feel the need to separate out from or cull from the herd, so to speak. And then on the next tab is the newer tab we just added for held to maturity securities. It's going to be pretty negligible for a lot of you out there. So if you just don't have anything from that perspective, it's okay, and it's not uncommon, I would just say. Next slide. This just reminds you how the scale tool works. So again, not our concept from a methodology standpoint, but certainly one you can utilize from the Fed with our help to make it a little bit more efficient. This is where that data comes from. So the scale tool starts by assuming that your losses going forward are going to match your peers' disaggregated loan loss reserve data. And what I mean by that is, starting a couple years ago, the larger banks over $1 billion in assets had to start filling out Schedule RI-C, which is where they had to plug in their reserves, not their total reserves, but their reserves by bucket. Now, there was only 6 buckets on Schedule RIC, so it's not a whole lot of granularity here, but it does give us a feel for what direction our reserves have been headed at some sort of segmentation for larger community banks and then national and regional banks. So looking at that data and chopping it up by region or by geographic area or by asset size and tracking it over time really does give us an idea of where the market has been going from a reserve standpoint, and that's the basis for the scale tool. And so in our interactive quick analytics platform, you can get and look at this data and slice and dice it any way you want to. An additional enhancement, so on our Q factor page, if you remember, there's a couple of columns for adjustments for peer data and economic data, but then we just leave it up to you to add additional columns for additional Q factor adjustments. We had a lot of users, who said it would be helpful to us if you would simply just kind of preload the Q factors tab with all those 9 suggested Q factor adjustments from the interagency regulatory guidance that we've had for over a decade now. I think that was like 2004 or something when some of that came out. So we decided we would go ahead and add a bunch of columns to the Q factor tab, at least by default, so you can see all those suggested adjustments. You can certainly remove columns here as you see fit if they're just not applicable for any part of your portfolio, but we thought it would help to just kind of see it all out there in black and white. So we're going to be adding those columns in the next few weeks.
Great, thank you, Steve. And so then just a final reminder as well, as Steve touched on, really in the tool, besides the call report, obviously we need to get the WARMs calculated. For some of you, this may be something very easily accessible through your core system. If it is not, we can help. So we work with our banks to assist them, and we'll actually calculate the WARMs for you. We obviously need some data from you, and so then we'll work with you to identify the necessary data. You can send that to us in a share file link, or we'll send you a share file link so you can send it to us. We will calculate the WARMs and provide you with a summary by each loan pool, so then you can put those numbers into the CECLSolver. So it's an additional step that's obviously necessary, but again, rest assured, if it's not something you want to do in-house, we will assist you in calculating those. One way to get that data is through the interagency loan data request form, the ILDR file. Some of you might refer to as the flat file. Again, I think if you want to, write an insurance policy for the future, I think this is a file that I would get familiar with if you're not already. I would warehouse it. This will allow you greater granularity should you ever need to do any type of loan level analysis in the future. Hopefully you will never do it, or need to, but it will certainly help to have the information should you want to or be asked to. So this is a good kind of, again, precautionary step. This is the same file you typically that you would provide your regulator with when they come in for a loan review. So, again, it's something you should be familiar with. You might call it something else, but again, at a minimum, I'd begin warehousing this at least on a quarterly basis for the future. As I mentioned, we can then, with that information, provide additional methodologies should you need them. We think for most community banks, it's not necessary, but we do want to point out to you, if you do need to dive deeper, we have the tools and resources here to help you through our IntelliCredit division. So kind of next steps. One, certainly thank you for attending today. Call or email if you have any questions. We'll schedule a time. We'll walk you through your data as Steve showed you here today. So we'll actually show you your real live data in a demo. We can assist you, with kind of getting going. As I mentioned, once a new subscriber, we'll walk you through those first, quarter numbers if you want to, and then we're here as much as you need us. If you have auditors, regulators, whoever, additional third parties who you need assistance with, we're always available to speak to them. We have shown this tool to regulators. Steve and I did a demo for the FDIC yesterday. Again, we've had very good reactions from all the regulators that we've shown the tool to. So, again, I think the bottom line is, you can feel comfortable, confident that there's over 300 banks using our tool. We've had, we've seen just about everything. It'll get you to the finish line, and we'll be here to help you. So don't let the anxiety of CECL, bother you anymore. There's a way to be helped, and again, we are happy to do that. As we touched on, we do have these monthly coffee talks. Our next one is coming up on August 12th at 10 a.m. Eastern. Again, the format here is a little bit different than what we do today. Typically, Steve, myself, and we'll actually have Josh Bowen on from Warren Avert, an accounting firm, who will join us. But essentially, we touch on a few topics, and then we really open it up to you or to our users, and we take those questions and answer them. And again, just try to kind of crowdsource or share, information that's relevant to all of you, but maybe, didn't find the opportunity to ask it, or maybe a question you hadn't thought of can be asked. So we found it to be a very effective way to share information with our users, and we do it monthly, and we'll continue to do it monthly, as long as necessary, certainly through next year. So at that point, again, on behalf of Steve and myself, I don't see any additional questions. If you want to submit anything at this point, we'll take those. But otherwise, we'll let you get back to your day. If you want to, again, sign up for a demo, please reach out to us. You can call us or email us, and we will walk you through your data. I hope you found the presentation helpful today. We thank you again for working with us here at Quick Rate and Quick Analytics, and we'll look forward to speaking to you soon. Have a great day.